This is part 2 of our Chapter 6 video lecture, where we're going to focus on other types of taxes that have to be paid in addition to the income tax reported on the 1040 form. So let's continue with our slideshow here on slide 10. Again, these slides are available in our chapter resources folder at our Lalima class site. So the nickname for this tax is called the kiddie tax because it taxes relatively young kids, dependents. And we learned last semester dependents are typically children under age 18 or full-time students under age 24. And the situation here is the parents of these kids are trying to reduce the parents' their own taxes by transferring investments to their kids because the kids are usually in a low tax bracket while the parents are typically in a higher tax bracket. To dissuade parents from doing this, they're going to charge the kids a higher tax rate on their income. The formula, kind of shown here on the next slide, says that the first $1,500 of the kid's income, they call it unearned income. Unearned meaning it's not from work. It's not from a business, but typically from investments like dividends and interests and rents, maybe even annuities. And they really didn't work for it. But the first 1,500 of that, $1,050 of that income is tax-free because that equals the amount of the smallest standard deduction any taxpayer can deduct. And then the next $1,500 of their unearned income is going to be taxed at the lowest rates of that child, which is typically 10% for a single individual. So that's now $2,100 of their unearned income. And then anything over that for the year, the government is going to tax them at a high rate that's subject to trust and estates, not relatively low rates of a single person, or maybe even a higher rate for the parent's return, maybe head of household or married filing joint. But these trust rates are relatively high, so you typically don't want to have kids having income like this is unearned income, because again, they're going to be paying high rates equal to what trusts and estates pay. So this would be added on to the parent's return or possibly reported on the child's own tax return for the year. So I won't go through the actual forms to fill out, but let's just move on to the next tax that is added on to the 1040 form called the Alternative Minimum Tax or AMT. The government tries to make sure that most people pay their fair share of taxes for the year. Of course, we know that's a hard job. We see rich people getting tax breaks, and that's why maybe this alternate minimum tax was developed to possibly have those rich people pay a little bit more taxes for the year. So here's the formula on one of the slides, but a better formula is probably on our textbook. So this is page 14, beginning with the taxpayer's regular taxable income we've been calculating on the 1040 forms last semester and so far this semester. But we cannot deduct the standard deduction. So this amount has to be backed out, increasing the taxpayer's taxable income. And then we're going to either add or subtract something called adjustments. Adjustments are amounts that will fluctuate over the years. So we kind of even it out by either adding them in one year and then maybe subtracting it out a following year. Now, the main thing that's being taxed for AMT is these things called preferences, stuff that gets taxed or not taxable on the regular income taxes. So these preferences are always added to the previous line to get a larger, what we call alt-min taxable income. And then we're going to reduce this AMTI by an exemption. So let's take a look at the table of different dollar exemption amounts. It's based upon the taxpayer's filing status. And here in this line called exemption amount, you can see the different dollar amounts. Now, these exemption amounts will be phased out or decreased if the AMTI, if the alternate minimum taxable income, exceeds this second row of numbers. And you can see it's a real big number. In past years, the threshold amount was relatively small, so the exemptions got phased out really fast. And even some moderate income taxpayers had to pay this AMT. Now, for the past couple of years, since 2018, because of this bigger exemption and because of the higher threshold, most people that used to pay AMT don't anymore because, again, they get to deduct that exemption amount right here. And then the rest of the income is now subject to the AMT tax rates, which is either 26% or if you go over a certain threshold, 28%. Okay, and again, we're calculating this AMT tax right here. Now, that's not what you're going to pay. You only pay an AMT tax if this amount right here is bigger than the regular income tax we've already calculated on the taxable income. And only the excess, the difference between the two, is what we call the AMT. So if this tax here is less than your regular tax, the AMT is 0. If this tax here is bigger than your regular tax, then the total taxes you pay, AMT and regular tax, is this amount. You pay this regular tax and you pay this excess amount. Let's see if we can find the form to calculate out this tax. Excuse me, this is a good example on page 16. Make sure you take a look at it, but let's take a look at the form. Here, this 2651. So again, your starting point is the taxable income on your tax return. And then you're going to adjust it for certain preferences or certain adjustments for the year. Let me kind of point out a couple here. So if you claimed itemized deductions in past years, maybe one of the big expenses, at least up to $10,000, is the state or local taxes you paid. Well, that has to be added back in over here. Added back in to make your income bigger. Another one would be, let's see if I can find it. This one right here. We know that municipal bond interest is tax-free, so it's not included in our taxable income. But if the municipal bonds were a type called private activity bonds, like if there was a private developer for a stadium or a nonprofit organization building a hospital, or even here in Hawaii, private schools borrowing money to construct classrooms. If it's sponsored by the state or county governments, these bond interest is tax-free for income tax purposes. But for AMT purposes, they have to be added back in. One of the big adjustments here, I don't see it on the list, but it's for stock options. So typically, if you have a company that doesn't have money to pay its employees, but it wants to pay them with stocks, one way to do that is giving them stock options. And if the options are exercised, the employee gets the stock and sells it, there may be a big gain, but part of the gain is excluded for income tax purposes. But here for AMT purposes, we may add that in to make that taxable income bigger. And again, we multiply this by a tax rate depending upon whether they exceed these certain limits are, this is really the exemption again, yeah, and it may be phased out if they go over certain limits. And we multiply it by a rate of either 26 or 28% if they exceed a certain limit to get the tax. Then we compare that with the regular income tax for the year that we've been calculating out through last and this semester. And only if the AMT exceeds the regular tax, the difference is what we call AMT that they have to pay. For most taxpayers, this regular tax is the only thing we have to pay because the tentative AMT is smaller than the regular tax. Again, it's reported on this form, and typically it's calculated automatically if you use tax software 2615. You do have to enter, though, the tax preference items in this line number 2. Let's move on to the next type of tax called self-employment tax. So most of us are familiar being an employee where we have to pay what we call FICA tax, yeah, Federal Insurance Contribution Act tax, that has two different taxes. One is called Social Security, or technically Old Age Survivor Disability Insurance. This is the one when you turn 66 or 67, you can probably start collecting. And the other is called Medicare. Typically when you're 65, you go into a hospital, this will help with your coverage for hospital costs. So as you work, you have to pay 6.2% of your wage or salary for the year up to a wage or salary of $128,400. If you earn more than this for the year, any excess is Social Security tax-free. But all of what you earn during the year is subject to this Medicare tax of 1.45%. Again, here on everything you earn for the year. So typically we say the FICA tax is the sum of these two here, yeah? 7.65%. But this is just really half of the tax. Your share, the employee's share, the employer has to match the same amount for the year. So the FICA tax is really over 15%. Again, this is where you have an employer and hiring employees. Now, if you're self-employed, you're really working for yourself, and you gotta pay double of the 7.65%. So you can see here the Social Security part and the Medicare part, all 15 plus percent now has to be paid by the self-employed taxpayer. That's what we learned last chapter, calculating their profit on a Schedule C, and now putting that profit on a Schedule E and taxing them on this for the self-employment tax. So let's go back to our book and see if we can find a Schedule E, SE. Okay, self-employment tax is on page 19. But let's take a look at the tax form, the Schedule SE. Looks like this is filled in for Norman. Again, Schedule SE would attach to the 1040 form. And there's two sides. This first side is the short form. And the main thing about this form is if you don't receive any wages, yeah, no here, from a job, you only have your own business, then you can use this front side. But if you do have wages and you also have your own business, then you probably got to use the back side, the long form. Let's assume you don't have wage income, just business income. So again, on that Schedule C, or if you're a partner in a partnership, that's what we call a K1 from the partnership return. You would put your profit over here, okay, your income from your business. And then you would multiply that amount, if you go down the formula, by this percentage rate. The government is helping you with giving you a discount by reducing the income that's subject to the tax, here by 7.65%. You kind of remember that number in the previous screen? They're kind of reducing your income. So you're really paying tax only on 92% of your income. And if the answer here in line 4 is less than $400 for the year now, you don't have to pay any self-employment tax. If it's $400 or more, then all of your self-employment income, all of the amount you're putting here in line 4 is going to be subject to the tax. And if your income is less than that dollar limit we saw for the year, then all of it is subject to this 15.3%. If you go over this 128,400 for the year, then the excess is taxed at this 2.9% for the extra Medicare costs. And then the rest is taxed at the 15.3%. Here's the maximum tax here, 15,922 on this 28,400. And to that you would add 2.9% of anything over 128,400. So here's the total self-employment tax. Now you got to report and pay with your income taxes of the 1040 form. And because this tax can be so big, again, the government will give you a break by allowing you to deduct half of that tax back on the 1040 form via Schedule 1 as an adjustment to AGI, an adjustment deduction. Okay, so to be able for you to figure out your income tax on the 1040 form, you gotta finish your Schedule C, you gotta finish this Schedule SE to eventually get this 50% deduction that goes back on the 1040 form, again via this Schedule number 1 to calculate your taxable income to figure out your regular income tax. Let's move on to the next tax here called the nanny tax. We heard the kitty tax, but here you're probably hiring maybe a nanny, a babysitter, or maybe a cook or maid. And all of these people, a yard person, to come to your home to work, not them working elsewhere, yeah? And if they're your employees, you gotta withhold and pay payroll taxes. There's a dollar limit though. If you pay less than this amount for the year, then you don't have to pay payroll taxes. Again, we're talking about the FICA taxes, half paid by the employer and the other half withheld from the employee's pay. If the employee wants you, the hiring party, the employer, to withhold income taxes, you got to withhold income taxes. And if you hire multiple people and pay them a total now, not just each individual, total of 1,000 for the year, you have to pay federal unemployment taxes. There may be also state income taxes involved. But in the case of the federal household employee taxes, it can be calculated on this Schedule H and attached to the 1040 form. Now adding that tax to the regular income tax you have to pay for the year. Some of you may have taken the college's Accounting 132 class. That's payroll taxes and Hawaii General Excise Tax, where you learn to fill out this form where you're a business paying employees and you have to pay and withhold payroll taxes. So we learn how to do that in this class. But if the employees are not for your business but only work in your home and you exceed this dollar limit, then you can calculate payroll taxes on this schedule. Let's move on to the next tax. So if you remember for the past few years, we always hear in the news, less so now, about the Affordable Care Act or Obamacare that helps people get covered with health insurance. So in addition to these people paying part of their own insurance costs, the government will help subsidize the premium costs. Well, that cost has to be paid by somebody, and it's coming from some taxpayers that are going to be paying additional taxes. Here, a 3.8% tax on something called net investment income. Typically, this is dividend income, interest income, probably rental income, over a certain dollar amount of AGI mentioned here. Okay, so this is additional tax calculated on another form and added onto the 1040 form. Another tax kind of mentioned in the previous slide is an additional Medicare tax. So we saw Medicare taxes and Social Security taxes in the previous slide, but this is additional. If you go in decimal, this is 0.009, percent, less than 1%. Again, over these dollar amounts. And if you're an employee, the employer would withhold this from your paycheck. If you're self-employed now, you got to calculate it on the backside of that Schedule SC form. Before we end this slideshow, let me review the taxes on the 1040 form. So again, here is our 1040 that we're familiar with, calculating out down to our taxable income. We would look this amount up on the tax table or tax rate schedule to get the income tax liability for the whole year. Here's that kiddie tax if you want to add it on to the parent's return. This one I haven't seen in years because typically it applies to very old people, I think like almost 90 years old now, that retired and took what they call a lump sum distribution. What we're concerned with in the second part of our current chapter is these other taxes here, including the self-employment tax, that are totaled here via Schedule number 2. So let's take a look at Schedule number 2. Here's the AMT, and you can see the form you have to fill out to put it the amount here if it does apply. Here's self-employment tax calculated on Schedule SE. If you have tip income that you didn't report to your employer, it's subject to income tax. And here on this forms, you may have to pay Social Security FICA taxes on that additional tip income. If you take out money too early, meaning before you reach age 59 and a half, there may be a 10% penalty tax calculated on this form 5329. Here's that Schedule H for household employees, withholding taxes. And here is those additional Medicare tax. Again, the net investment tax and additional Medicare tax. Again, you add them all up and you carry it back to the 1040 form, adding it to your income taxes, making your income taxes bigger. Of all these taxes mentioned, probably the most common one is self-employment if you have your own business. Otherwise, you may not see these other ones most times on most tax returns. Okay, that's it. Make sure you read the chapter. Of course, you've already watched these videos. Now you're ready to do the assignments as scheduled and announced in our class messages. Yeah. If you have any questions, go ahead and email me.